Share Market Investing 101. Build wealth safely. Welcome to Investing Made Simple. Have you ever wished you could make money while you sleep? That's what investing is all about. We're going to take complex ideas about growing your money and break them down so simply that anyone, even if you're just starting, can understand them. Let's start growing your money tree. Okay, part 1. Why should you even care about this right now? You might think investing is for old people in suits, but the truth is, the younger you start, the more powerful you become. You have a secret superpower, and we're going to show you what it is. Believe it or not, your biggest investing superpower isn't having a lot of cash, it's time. Since you're young, you have a huge time horizon. This is just a fancy way of saying you have lots of time before you'll need this money. This time is what lets you ride out any bumps in the market and, more importantly, it unlocks the magic of compounding. This is the magic snowball, we call it compounding. It's the most powerful force in finance. When you invest, your money earns a little bit more money, right? Well, that new, extra money also starts earning money. It's the difference between earning a slice of pie every year, simple interest, and earning an ever-growing, larger slice of pie every year, compounding interest. The longer you let it compound, the bigger the slice gets, until the interest you are earning starts to become more than your original investment. Let's look at an example. If you start investing $100 a month at age 18, by the time you're 65, you could have over $250,000. But if you wait until you're 30 to start, you'd only have around $120,000. Look at that difference. You end up with more than double the money, just because you gave your snowball an extra 12 years to roll. That is the power of starting now. Okay, part 2. You're convinced, you want to start. How do you actually do it? It's not as hard as it sounds. You just need the right tools, which is your investing toolkit. Let's break it down. You really only need 2 things. First, you need a broker. Think of this as the online store, like Amazon, but for investments. It's the website that lets you buy and sell. Second, you need a cash account, or wallet. This is a special bank account that's linked to the shop. You move your money from your normal bank account into this wallet, so it's ready to go when you want to buy something. So, what exactly is a broker? It's just the company that does the trading for you. You can't call up the stock exchange yourself. You use an app or website, and the broker makes the trade happen. You'll see full-service brokers, which are like big department stores with lots of features, and low-cost brokers, which are more like simple, cheap convenience stores. For starting out, low cost is usually the way to go. You might see the term CDIA. That just stands for Commonwealth Direct Investment Account, which is CommSec's specific name for the wallet. Why can't you just use your normal bank account? This special account is linked directly to the shop to make trades happen instantly. It also helps you stay organized by keeping your investment money separate from your lunch money. Fees matter a lot. This is super important. Fees are like termites eating at your investment. If you invest $500 and pay a $10 fee, you've instantly lost 2% of your money before you've even started. But if you use a low-cost app and pay a $2 fee, you've only lost 0.4%. You get to keep $498 working for you. When you're investing small amounts, you must choose a low-fee broker. Let's look at some low-cost apps that lets you invest with very minimal fees. An app like CommSec Pocket is a perfect place to start. It's designed for beginners. You can start with as little as $50, the fee is only $2, and best of all, it's not overwhelming. It only gives you 7 simple options to choose from, which are all the baskets, or ETFs we're about to talk about. It's a great way to dip your toe in the water. Okay, part 3, the big question. What do you actually buy with your money? You've got your shop and your wallet, now you're standing in the aisle. You'll hear 2 main words, shares and ETFs. Let's break them down with a simple analogy. A share is like buying one single Lego brick. You own a tiny, tiny piece of one specific company. You could buy a share of Apple, or a share of Commonwealth Bank. It's pretty cool, but it's also risky. What happens if you drop that one brick, or if that one company does badly? All your money is tied up in that one single brick. Now, an ETF is like buying the giant Lego box. With one purchase, you get a box that contains tiny pieces of hundreds, or even thousands, of different companies. For example, you can buy an ETF that holds the 200 biggest companies in Australia. You instantly own a piece of all of them. This is a much safer and simpler way to start. The magic of ETFs is a concept called diversification. You've heard the saying, don't put all your eggs in one basket. Buying a single share is doing exactly that. If that one company fails, your money is gone. Buying an ETF spreads your money, your eggs, across hundreds of companies, baskets. If one company fails, you barely even notice. This is the simplest way to invest safely. You might also hear about managed funds. These are also baskets, just like ETFs. But the difference is that an ETF just follows a simple rule, like, buy the biggest 200 companies. A managed fund has a highly paid expert, like a chef, who is constantly buying and selling, trying to pick the winners. This sounds good, but history shows most of them fail to beat the market, and you have to pay them much higher fees for trying. So, for beginners, ETFs are the clear winners. Why? 1. They are super low cost because there's no expensive manager to pay. 2. They are incredibly simple. You don't need to be an expert. And 3. You are instantly diversified, which protects your money. They are the perfect, simple, low-cost tool for long-term growth. Part 4. Your smart strategy. You've got your tools and you know what to buy, an ETF. Now, how do you buy it? What's the plan? Having a simple, strong plan is what separates successful investors from gamblers. First, let's talk about the worst strategy. It's called timing the market. This is when people try to guess the future. They look at the news, get scared, and sell. Then they get excited and buy. They're always jumping in and out. The truth is, nobody can predict the future. This is just gambling with a crystal ball, and it almost never works. The best strategy is boring, but it works. It's called dollar cost averaging, DCA. It just means you invest the same small amount at the same time, every single month, no matter what. You ignore the news and just keep going. This removes all the emotion and stress. Sometimes the market is down, which is great. It means your $50 buys you more pieces. It's the secret to stress-free wealth. Your strategy also depends on your time horizon we talked about. Think of it like a risk dial. If your goal is long-term growth, money you won't touch for 10, 20, or 30 years, you can set your dial to 90% growth, assets like ETFs. You have time to ride out the bumps. But if you're saving for a car in 2 years, that's short-term saving. You need safety, so you just keep that money in cash. For wealth growth, we set the dial to growth. Okay, part 5. As if growing your money wasn't cool enough, you also get paid bonuses along the way, especially in Australia. These bonuses can seriously speed up your wealth growing snowball. Let's look at the two big ones. The first bonus is called a dividend. When the companies in your ETF make a profit, they often share that profit with their owners, that's you. It's a cash, thank you, payment that lands in your wallet. The smart thing to do is immediately reinvest it. Use that bonus money to buy even more ETF pieces. This is pure compounding in action. The second major bonus, particularly relevant here in Australia, is called a franking credit. This can be a bit complex, but here's the gist. A company pays tax, and then they pay you a dividend. If you then pay tax on that dividend, the money has been double taxed. The franking credit is a tax coupon that says, hey, the company already paid tax on this money, so you don't have to pay all of it again. This makes Australian ETFs extremely tax efficient, often reducing your tax bill or even giving you a refund. Let's bring it all together into one simple plan. 1. Get your tools, a low-cost broker and a wallet. 2. Buy a simple, broad, low-fee ETF, the giant basket. 3. Use dollar-cost averaging, invest the same small amount every single month. And 4. Reinvest your dividends to boost that compounding snowball. Stick to this plan, and you will be miles ahead. Thank you for watching the Invest Smartly Tips video. I know this was a lot of information, but remember the one takeaway: start your snowball today. The hardest part is starting.